General purpose financial statement are those intended to meet the needs of users who are not in a position to demand reports tailored to meet their particular information needs. Objectives of general purpose financial statement. The objectives of general purpose financial statements of a public sector entity are: A. To provide information about the entity's financial position, financial performance, and cash flows that is useful to a wide range of users in making economic decisions. And B. To demonstrate the accountability of the entity for the resources entrusted to it. Next is responsibility for financial statement. The responsibility over financial statement rests with the entity's management, particularly the head of the entities jointly with the head of finance or accounting. A statement of management responsibility for financial statements shall be attached to the financial statement as a cover letter. This is the example of a cover letter. Components of general purpose financial statement. A. Statement of financial position. B. Statement of financial performance. C. Statement of changes in net assets or equity. D. Statement of cash flows. E. Statement of comparison of budget and actual amounts. And F. Notes to the financial statement comprising a summary of significant accounting policies and other explanatory notes.
General principles are fair presentation, compliance with PPSAS, departure from PPSAS, going concern, consistency of presentation, materiality and aggregation, offsetting, comparative information, identification of the financial statements, and the reporting period. Fair presentation means the faithful representation of the effects of transactions and other events in accordance with the definition and recognition criteria for assets, liabilities, revenue, and expenses in the PPSAS. Fair presentation also requires the proper selection and application of accounting policies in accordance with the PPSAS. Next is the compliance with PPSAS. An entity whose financial statements comply with the PPSAS shall make an explicit and unreserved statement of such compliance in the notes. Financial statements shall not be described as complying with the PPSAS unless they comply with all the requirements of PPSAS. Departure from PPSAS. In the event that management strongly believes that compliance with the requirement of PPSAS would result in misleading presentation, that it would contradict the objective of the financial statements, the entity may depart from that requirement if the relevant regulatory framework allows or otherwise does not prohibit such as departure. Going concern. Financial statements shall be prepared on a going concern basis unless there is an intention to discontinue the entity operation or there is no realistic alternative but to do so. Consistency of presentation. The presentation and classification of items in the financial statement shall be retained from one period to the next unless laws, rules and regulations, and PPSAS require a change in presentation. Materiality and aggregation. Each material class of similar items shall be presented separately in the financial statement. Items of dissimilar nature or function shall be presented separately unless they are immaterial. Lastly is the identification of the financial statement. The financial statement shall be identified clearly and distinguished from other information in the same published document. Period. Financial statements shall be presented at least annually. When an entity changes the reporting date such that its annual financial statements are presented for a period longer or shorter than 1 year, the following shall be disclosed: the period covered by the financial statement, the reason for using a longer or shorter period, and the fact that comparative amounts are not entirely comparable.
Statement of financial position has two formats: condensed statement of financial position and a detailed statement of financial position. Condensed statement of financial position presents only the line items shown below. The breakdowns and other relevant information are disclosed to the notes. A. Cash and cash equivalents. B. Receivable from exchange transaction. C. Recoverable from non-exchange transaction, taxes and transfers. D. Financial assets excluding amounts shown under A, B, and C. E. Inventories. F. Investment property. G. Property, plant, and equipment. H. Intangible asset. I. Taxes and transfer payable. J. Payables under exchange transactions. K. Provisions. L. Financial liabilities excluding amount shown under H, I, and J. And M. Net assets or equity. The detailed statement of financial position presents all the assets, liability, and equity accounts in the revised chart of accounts. These are the two examples of condensed and detailed chart. Both the condensed and detailed statement of financial position form part of the entity's annual financial statement. The statement of financial position shall show distinctions between current and non-current assets and liabilities. Any of the following would lead to the current classification of an asset or liability. A statement of management responsibility for financial statements shall be attached to the financial statement as a cover letter. Statement of financial performance. The statement of financial performance shows the revenue, expenses, and surplus of deficit for the period. It is presented in comparative, condensed, and detailed format. Generally, revenue and expenses are recognized in surplus or deficit, except the following, which are recognized directly in equity. A. Correction of prior period errors. B. Effect of changes in accounting policies. And C. Gain of or losses of reassuring available for sale financial assets. The following are the minimum line items to be presented on the face of the statement of financial performance. A. Revenue. B. Finance cost. C. Share in the surplus of deficit of associates and joint ventures. D. Gain or loss attributable to discontinuing operations. And E. Surplus or deficit. Statement of changes in net assets or equity shows the increase or decrease in the entity's net assets during the period resulting from the following. A. Surplus of deficit for the period. B. Items of revenue and expense that are recognized directly in equity. C. Effects of changes in accounting policies and corrections of errors. And D. The balance and accumulated surpluses of deficit at the beginning of the period and at the reporting date and the change during the period.
Statement of cash flows. The statement of cash flow shows the sources and utilizations of cash and cash equivalents during the period according to the following activities: operating activities, investing activities, and the financing activities. Operating activities. Cash flows from operating activities are primarily derived from the principal cash generating activities of the entity. They normally include cash flows on items of revenue and expenses. Example are receipt of NCA and reversion of unused NCA. Investing activities involve the acquisition and disposal of non-current assets and other investments. Example are acquisition and disposal of investment securities and derivatives. Financing activities are activities that affect the entity's equity, capital, and borrowing. Example is issuing of notes, loans, and bonds payable and their repayments.
Presentation of cash flow. Operating activities. Cash flows from operating activities are presented using the direct method. Investing and financing activities. Cash flows from investing and financing activities are also presented according to major classes of gross cash receipts and gross cash payments.
This is an illustrative statement of cash flows.
The statement of comparison on budget and actual amount shows the following. A. Budget information consists of, among others, data on appropriation, allotments, obligations, revenues, and other receipt and disbursement. This is based on the budget registers including the following. 1. Original budget is the initially approved and budget for the period, usually the general appropriation account. 2. Final budget is the original budget adjusted for all the reserves, carryover amounts, realignments, transfers, allocation, and other authorized legislative or similar authority change applicable to the period. B. Actual amounts on a comparable basis. This represents the actual disbursement made during the period. S differences occur when the approved budget is prepared on a basis other than the accounting basis. 2. Timing differences occur when the budget period differs from the reporting period reflected in the financial statement. And 3. Entity differences occur when the budget omits program and entities that are part of the entity for which the financial statements are prepared. Differences between A and B above explanation or material differences shall be made in the notes.
The notes to financial statements provides information in addition to those presented in the other financial statements. It is an integral part of a complete set of financial statements. All the other financial statements are intended to be read in conjunction with the notes. Accordingly, information in the other financial statements shall be cross-referenced to the notes.
Events after the reporting date. Events after the reporting date are those events both favorable and unfavorable that occur between the reporting date and the date when the financial statement is authorized for issue. These include the following. A. Adjusting events, those that provide evidence of conditions that existed in the reporting date, and B. Non-adjusting events, those that are indicative of conditions that arose after the reporting date. Reporting date, end of the calendar year, date of authorization of financial statement for issue, date of signing of the statement of management responsibility for a financial statement by the head of agency and head of financial department. The following are considered changes in accounting policies. A. Change from one basis of accounting to another basis of accounting, and B. Changes in the accounting treatment, recognition, and or measurement of a transaction, event, or condition within a basic of accounting.
Changes in accounting estimates, results from new information or new developments, and accordingly or not correction of errors. Errors include mathematical mistakes, incorrect application of accounting policies, oversight of misinterpretations of facts, and fraud. Errors can arise in respect of recognition, measurement, presentation, or disclosure of items in the financial statements. Financial statements do not comply with PPSAS if they contain material errors or immaterial errors made intentionally.
Errors can be classified as follows. A. Current period errors. Errors committed and discovered in the current year. These are corrected by correcting entries within the same year. B. Prior period errors. Errors committed in the prior year that are discovered in the current year. These arise from failure to use information that 1. Was available when the prior year's financial statement were authorized for issue, and 2. Could reasonably be expected to have been obtained and taken into account when preparing those financial statements. Consolidated and separate financial statements. A controlling entity is required to present consolidated financial statements except in cases where the controlling entity is a controlled entity itself and its securities are not being traded. Separate financial statements are those presented by a controlling entity and investors in an associate or a venture in a jointly controlled entity in which the investments are accounted for on the basis of their direct net assets or equity interest rather than on the basis of the reported results and net assets in the end business. Interim financial statements. Government entities prepare interim financial statements on a quarterly basis using the same accounting policies used in annual reports. Other reports. In addition to the financial statements, government entities are also required to prepare and submit the following reports. 1. Trial balance, pre-closing and post-closing. 2. Other schedules. A. Regional breakdown of income. B. Regional breakdown of expenses. Deadlines on submission of reports. A. Provincial office and operating units. B. Regional or branch offices. C. Central or head or main office.